Hi, in this video what we will see is how we use the information we saw in the previous video in order to decide on whether or not to do the project. So we will look at investment decision rules. What we saw in the previous video was that for every single period, let's say a year, for every single year we will be able to estimate the free cash flow. So for year one we will have a certain free cash flow, also free cash flow on year two, free cash flow on year three, free cash flow on year four. And also we have the free cash flow on year zero, which is usually the initial investment. So we have this series of cash flows which are estimates of both operating cash flows and investment cash flows. So we plug all these things together and we get those estimates. Then what we have to do with this is calculating the investment decision rules. The most common one and the most relevant one is the net present value. The net present value is commonly used because it will give you, as the name suggests, the net value, because it will take into account cash inflows and cash outflows. And the present value means that you have to discount every single cash flow to the present. So what we have here will be the sum of all the free cash flows discounted to the present. So now we estimated all the free cash flows, including this one. So we start on t equal to 0. We start here and we sum all the cash flows that we estimate for the project. Either it lasts 5 years or 50 years, and we get the NPV. Once we get this, we are able to decide on whether or not to take the project. If the NPV is larger than 0, so if the NPV is positive, we accept the project. It is creating value on top of the initial investment. So we have this scenario here, which is what we desire, which is accepting the project, having a positive NPV. If the NPV is negative, we reject the project. We are not creating sufficient value. So we should not go on with this project. If it is 0, we are indifferent. Either we do it or not, we will have the same value. So this is the first and the major decision rule you may have. You accept projects with a positive NPV, you reject those that don't have a positive NPV. Another thing that you should look at is the internal rate of return, which is a measure of the return of the project as a percentage of the initial value. And we get this, the calculation of this return depends on the NPV. And what we do is we set the NPV to 0 by changing the discount rate. So as we can see, the discount rate influences the NPV, and the internal rate of return is the discount rate that sets the NPV to 0. Once we find the internal rate of return, we can also say whether or not we accept the project, in general, in most cases. If the internal rate of return is larger than the discount rate, it means that the return you are getting is above the discount rate. It is above the opportunity cost. So you are getting more than your best alternative. So in this case, you accept the project. And if the internal rate of return is smaller than the discount rate, you reject the project. It means that you are generating less return than your best alternative. These conclusions here can be drawn in the typical examples where you have initial investment and then cash inflows. This internal rate of return sometimes does not work properly. And finally, we have the payback period. The payback period will tell you how much time do you have to wait until you recover the initial investment, which is usually a useful information. You accumulate cash flows up to the moment in which you get back the initial investment. And the payback period will be like 3 years, and you know that in 3 years you will recover the initial investment. Here there is no clear-cut rule, so there is no predetermined criterion. It is more informative and it will depend on different investors. So these are the 3 basic decision rules. There are other, but these ones are usually enough, at least for a first glance, on whether the project is viable or not.